welcome back to this explainer. Today, we're unlocking the world of real estate for everyday people. If you've ever looked up at a gleaming city skyline and thought, man, only billionaires get to own those. Well, think again. We're diving straight into REITs, real estate investment trusts, and showing you how they literally let you own the buildings, not just the bricks, without needing a massive trust fund. Seriously, picture that premium, grade A office tower sitting right in the middle of the city center. The price tag on that? $2 billion. You would need, what, 100 lifetimes of your current salary just to buy the lobby? But here is the absolute wildest part, the impossible reality. You can actually own a slice of that exact same skyscraper before your morning coffee even gets cold. And the entry fee? It's right around $100. So let's break down how this actually works.
Okay, so a real estate investment trust, or a REIT for short, is essentially a company that pools money from thousands of individual investors, exactly like you. Think of it like a giant collective war chest. Your $100 joins millions of other dollars, which gives the REIT this massive buying power. Suddenly, they can swoop in and purchase what we call trophy assets, stuff like massive logistics hubs, absolutely essential data centers, and yeah, those premium office skyscrapers. It's basically a private equity syndicate, but built for everyone.
Now let's look at the architecture of how this whole thing operates. You, the unit holder, are sitting right at the top. The REIT pools your investment, and in return, you get regular distributions. But the best part? You don't have to go out and physically collect rent or, fix a leaky roof on a Saturday. Professional managers handle all the day-to-day operations and figure out the strategic direction of the assets. So you get the financial perks of property ownership while entirely bypassing the headaches of actually being a landlord.
It all builds into an incredibly straightforward, predictable real estate machine. Step 1, tenants. And we're talking everyone from small local businesses to massive international corporations. They sign leases and pay rent every single month. Step 2, those professional managers we just talked about, they run the buildings, find the tenants, and take those awful 2 a.m. plumbing calls. And step 3, the net rent flows directly out to you, the unit holder, as cash distributions. Literally, you own real property income without ever holding a single set of keys.
Now, you might be wondering, why on earth do REITs actually pay you so consistently? Why wouldn't the company just keep the profits for themselves? Well, it all comes down to one massive number, 90%. And this isn't just some friendly suggestion or guideline. This is literally the one golden rule that powers the entire REIT structure.
It's called the 90% distribution rule. This rule dictates that a REIT absolutely must pay out at least 90% of its taxable income to its shareholders every single year. If they do this, the REIT completely avoids double taxation. They pay zero corporate taxes on that income. So the law literally forces REITs to act as income machines that pay you. But there's a flip side here. Because they are legally required to hand out almost everything they earn, REITs retain very little cash on hand. So to fund external growth, like buying a new mall or warehouse, they usually have to go out and borrow money or issue new shares. Keep that tucked away in your mind, because it is absolutely fundamental.
To really grasp the power of this setup, we need to reframe how you look at the investment itself. A REIT isn't just some random stock ticker that you trade hoping to make a quick, short-term gain. You really want to think of it as co-owning the landlord. Picture a legendary, super profitable hawker stall, right? But instead of one single owner, it's co-owned by 1,000 people. Nobody's trying to flip the stall to a new buyer every week. Instead, everyone is just happily collecting their share of the daily takings when they close up shop.
And the data absolutely backs up why this mindset matters so much. Let's look at the numbers for Singapore REITs, or S-REITs, which actually make up one of Asia's largest REIT markets. The average distribution yield sits at an extremely impressive 5.9%. Just compare that to the broader stock market, the STI index, which is around 4.6%, or the ultra-safe MAS 10-year government bond down at 2.1%. By pooling capital and locking in that tax-exempt 90% payout rule, REITs consistently offer some of the most compelling yields out there. To put that into perspective, on a $10,000 stake, a 5.9% yield means roughly $590 in rent hitting your account every single year.
Okay, let's actually test your newfound expertise with a quick mental check. Let's say you own 1,000 units of a REIT. Over the course of the year, that REIT earns 10 cents per unit in taxable income. Based on that golden rule we just covered, what is the absolute minimum it must pay out to you? I'll give you a second to just quickly run the numbers in your head. Got it? It's $90. Let's break that down real quick. 90% of that 10-cent earnings is 9 cents, right? Multiply that 9 cents by your 1,000 units, and boom, you get $90 delivered straight to your brokerage account.
That is the 90% rule working tirelessly in your favor, legally binding the REIT to share its profits directly with you.
All right, let's lock in everything we've covered today. You started this explainer knowing that commercial real estate is insanely expensive and pretty much completely out of reach. But now you know the 3 core pillars of a REIT. Number 1, pooled capital gives you access to billion-dollar trophy assets. Number 2, a professional landlord handles all the heavy lifting and midnight tenant complaints. And number 3, a massive 90% payout is forced by law, turning rent checks into passive distributions for you. You can now confidently explain to anyone exactly where a REIT yield comes from.
But hey, before you go out and buy up every single REIT you can find, we have to ask a really critical question. Are all REITs actually safe? Because frankly, not everything calling itself a REIT deserves your hard-earned money. To keep their special tax-free status, they don't just have to pay out 90% of their income, they also have to pass some incredibly strict asset and income tests to prove they are genuine landlords, not just speculative traders. In our next explainer, we are going to break down the 4 statutory gates every REIT must pass and the one specific type of REIT that beginners need to approach with extreme caution. Thanks for learning with us, and we'll see you in the next one.